Hello friends, what's up? Let us continue taxes in India, this particular lesson. In this lesson, we will study direct taxes in India in more detail. In the previous video, we have already seen what are direct taxes. Direct taxes basically means the taxes which are directly collected from the people who bear the tax burden, right? Directly paid by the people who bear the tax burden. So we have already seen this in the previous video. Let us look at different kinds of direct taxes in India. The first one is the corporation tax or corporate tax as we call it. In the Indian annual financial statement, we will see that it is written as corporation tax. So as the name itself suggests, it is levied on the companies or organizations under the Income Tax Act. So both Indian and foreign companies, Indian and foreign organizations have to pay the corporate tax. It is levied on the net profits of the company. So out of net profits also there are some deductions and exemptions. Okay, deduction and exemptions happen according to the Income Tax Act, and whatever is a taxable income on that this corporate tax is levied. Then there is one more concept called as minimum alternate tax. Minimum alternate tax basically is imposed on company which are known as zero tax companies. So there are a few companies which misuse the provision of the IT Act and they use all these deductions and exemptions which are not legal at all, and they show that their taxable income is zero. They make their taxable income to be zero. So there is a concept called minimum alternate tax. It was introduced in 1988, long ago, and as the name itself suggests, basically there is a minimum amount of tax that the company has to pay regardless of the profit. Okay, so whatever is your profit, the company has to pay a minimum amount of tax. For example, the minimum tax is say 15% or say 18%. So if the corporate tax is say 25% and you show that your book profit or your profits in your account is that your profit is say 75 lakh rupees. Okay, but after deductions your taxable income, your taxable profit after deduction is say only 30 lakh rupees. Okay, for a company. Now this is after deductions and this is actually the book profits. So as per the original provisions of IT Act, the 25% corporate tax will be levied on this taxable income. So say for example, and of course there are surcharge and cess also, but let us ignore that there is no surcharge or cess. So 25% will be levied on 30 lakhs, and tax at 25% on taxable income will be equal to 25% of 30 lakhs, which is equal to 7.5 lakh. Now if the minimum alternate tax, say the minimum alternate tax is 15% of the original profit, the book profit, which is 75 lakhs. So the tax calculation as per the MAT will be 15% of 75 lakh. Okay, so 15% of 75 lakh will come out to be near about 10.5 lakhs. Okay, or something little bit here and there. Now you can see that as per the MAT, the tax has to be paid is 10.5 lakh, but after the deductions and exemptions, the tax that company is supposed to pay 7.5 lakh. So the differential amount will be paid as MAT. Okay, so the company has to pay around 3 lakh rupees as MAT, which is the minimum alternate tax. So company has to pay a minimum alternate tax of 10.5 lakh rupees, but as per the Income Tax Act it is paying only 7.5 lakh. So the remaining 3 lakh it has to pay as a part of MAT. So it is basically in order to have some minimum tax from the company so that it does not take undue advantages of the deductions and exemptions. Okay, so I am just showing this to explain you the concept. This 15%, 18%, this number keeps on changing every year. And also the rate of corporate tax, it keeps on changing. Currently in the 2022 year, the rate of corporate tax is 25% plus different kind of surcharges, okay, plus different kind of cesses. Okay, so this is how the corporate tax is levied in India. Then the second kind of tax is fringe benefits tax. It was started in 2006. Fringe benefits tax is imposed on items and services an employer provides to the employees. Example, accidental and health benefits, which is not part of the salary but it is given to the employees. This is additional benefit that the company gives to its employees. Then there are certain achievement awards also, right? There are some kind of bonuses also, okay, which are sometimes given to the employees. So the tax which is imposed on such different kinds of benefits is known as fringe benefits tax. Then there is another kind of direct tax which is known as Dividend Distribution Tax, DDT. It is a tax on distributed income to unit holders. For example, there is a Reliance company, okay. The Reliance company is paying dividend of rupees 2000 per share annually to its shareholders. Now, for example, if you have say 100 shares of Reliance, okay, if you have 100 shares of Reliance, so the total dividend that you will receive that year will be 2000 multiplied by 100, which is equal to 2 lakh rupees, right? So this 2 lakh rupees is your income from dividend distribution. Now you have to pay some tax on this 2 lakh rupees, say 10%. So 10% of 2 lakh is 20,000 rupees will be your DDT. You will be paying 20,000 rupees as dividend distribution tax. However, this dividend distribution tax was abolished since 2020. So Government of India has already abolished DDT from our system. Okay, but I have put it here just in order to show you that this is also one kind of direct tax. Now there is another kind of tax which is known as Securities Transaction Tax. It is a tax on value of securities transacted through a recognized stock exchange. For example, if you buy shares of Tata Motors, for example, okay, worth rupees 5 lakh. Suppose you purchase 1000 shares, okay, 1000 shares worth rupees 500 each. So you are basically buying shares of 5 lakh rupees, okay. Now there will be a securities transaction tax. So basically you are doing transaction of 5 lakh rupees. So Government of India will take some 1% or 2%, whatever is the rate, securities transaction tax on this particular amount. So say if it is 1%, then you will pay 5,000. Then you will pay 5,000 rupees. 5,000 rupees as the security transaction tax. However, this is also a kind of indirect taxes in our annual financial statement. This can be seen under the indirect taxes because actually this money is taken from the from the stock exchange account or your it is collected from where you are performing your transactions. So in a way it is also an indirect tax, right? Because you are not directly paying it to the government, but it is being deducted from your transaction, okay. And later on the stock exchange or the company through which you are doing this transaction is paying it to the government, right? So this is the securities transaction tax. Then the second one is wealth tax, okay. Wealth tax, it also includes the estate tax. We have seen in the previous video what are wealth tax and estate tax. Estate tax is something you pay a tax on the inheritance, whatever you inherit from your say parent, from your family. And wealth tax is a tax that you pay on the property that you are holding at the current moment. So right now, how much ever property you have, whatever tax you are supposed to pay, it is known as wealth tax, and estate tax is whatever you inherit. So this is a kind of one time tax, this is a kind of annual tax. So it is basically paid by wealth means what? Any property or assets a person holds or a company hold, but it was abolished in 2016-17. So wealth tax was also done away with from our Indian system in 2016-17. Then the third kind of direct tax is taxes on income. This is the most famous, most well-known direct tax, right? Because we usually common people deal with income tax only. So perhaps income tax is the most well-known direct tax imposed by government on our annual income. So income tax is imposed on your annual income. There are different slabs. Depending on which slab you fit into, the government will impose the income tax. Now income tax also includes the capital gains tax. This is an important concept. Okay, so for example, if you are an employee in a private company and your annual salary, suppose annual salary that you are receiving is say rupees 10 lakh. Okay, you're receiving annual salary of rupees 10 lakh. This is your taxable income. For a moment, consider that this is your taxable income. There is no deductions for simplicity. And you have also gained some profit because of the transactions you do of your property or the capital that you hold. And say for example, the capital gains you get in that particular year is say rupees 2 lakh. So you earn a profit of 2 lakhs by doing some transaction in some assets, and therefore your total income will be rupees 12 lakh. Okay, so 12 lakh will be the total income that is considered okay for that particular year. However, the income tax will be levied on this salary that you are earning from your regular employment, and capital gains tax will be dependent on what kind of capital gain tax it is. Okay, so you will not directly fit into that particular slab for 12 lakh, but you will pay the regular income tax for 10 lakh rupees and you will pay the capital gains tax for 2 lakh rupees. But together the total income tax plus capital gains tax you will pay at the same time, okay, to the IT department, like that. Now we'll see what is the meaning of capital gains and what is the meaning of capital gains tax. Now capital gains means what? Means for example, you have some property, you sell that property. So whatever is the sale value minus whatever is the purchase value. आपने कितने में वो प्रॉपर्टी खरीदी थी और कितने में प्रॉपर्टी आप बेच रहे हैं. फॉर एग्जाम्पल, यू परचेस्ड अ पीस ऑफ लैंड. ओके, यू परचेस्ड अ पीस ऑफ लैंड एट रुपीज 1 करोड़ in 2015. Okay, now you are selling this land in say 1.5 crore in 2020. So in 5 years you are gaining 50 lakh rupees as profit. So your capital gains is 50 lakhs. Now whether this 50 lakhs is long term capital gain or short term capital gain, that is again defined. Okay, so whether this 50 lakhs is long term or short term gain, because you are earning this 50 lakhs in 5 years, okay, we have to categorize it either as long term or short term. Now how our government rules define it. For example, if it is an immovable property or real estate, meaning land or flat or apartment, if it is a real estate, then if the gain is within 2 years, then it is known as short term. Okay, and if it is more than 2 years, then it is long term. सो यदि आप ये प्रॉफिट 2 साल के अंदर कमाते हैं तो उसको शॉर्ट टर्म बोला जाता है फॉर रियल इस्टेट. ओके, इफ इट इज अनदर काइंड ऑफ एसेट, फॉर एग्जांपल डेट फंड. ओके, इफ देर इज अ काइंड ऑफ डेट फंड or any other asset like movable property, for example laptop or mobile phone or any other painting. For example, you have some painting, okay, you purchased a very beautiful painting and at that time the cost of painting was say 10 lakh rupees. Now after 4 years the cost of painting becomes 20 lakh. So in 4 years your capital gain on that painting is 10 lakh rupees, right? The capital gain on that painting is 10 lakh rupees. And for such kind of assets, the short term is considered to be 3 years. Okay, for the debt fund or any other kind of assets like movable property, the short term is considered to be 3 years. So if within the 3 years if you are getting the profit, then it is known as short term gains. If it is a profit after 3 years, then it is known as long term gain for this particular kind of asset. Then there is another kind of asset which is known as equity, stocks, right? You have some stocks, mutual funds or bonds. जो भी आपने इन्वेस्टमेंट किया होगा, वॉट एवर इन्वेस्टमेंट यू मे हैव डन इन स्टॉक, शेयर्स, म्यूचुअल फंड्स, बॉन्ड्स, different kind of instruments, for that the short term is defined as only 1 year. So if you get the profit within 1 year, it is known as short term. If you get the profit after 1 year, it is known as long term. For example, if you purchase the share of Reliance, if you purchase the share of Reliance in February 2020, okay, at rupees 5 lakh, if in April 2020 itself, after 2 years, the value of this share becomes 5.5 lakh. So this 50,000 profit, okay, this 50,000 profit is short term gain because it is within 1 year. But if it was say April 2021, then this would be long term capital gains, right? So this is how it is defined. You have to keep this in mind. 1 year, 2 year and 3 year. For share, stocks, mutual fund, bonds, it is 1 year. For real estate, it is 2 years. For debt funds, it is 3 years. This you have to keep in mind. Now, how the government taxes this? If it is real estate and debt fund, then the long term capital gains tax is 20%. It is a flat 20%. So whatever you get in the long term on these two kind of assets, the long term capital gain tax rate is 20%. If it is on equity, shares, mutual fund, bonds, etc., and if the gain is more than 1 lakh, then the LTCG rate is 10%. यदि यहाँ पे आप 1 लाख से कम कमाते हैं तो LTCG will be 0%. Okay, if the gain on stocks, mutual fund, bonds, etc. is less than 1 lakh in the long term, then the rate of LTCG is 0%. But if your overall profit is more than 1 lakh, then the LTCG will be 10%. This is how it is done. It is a bit complicated, but that is how we have it in the in our system right now. Whereas short term capital gains tax is a flat 15% for each kind of asset, whether it is this or this. It is a flat 15%. And this 15% is there if the securities transaction tax is applicable. So for example, if you had paid the securities transaction tax at the time of transaction, you will pay a STCG of 15%. Whereas if you had not paid the securities transaction tax, see, there are some gains where there is no securities transaction tax, like for example real estate. So in real estate, you don't really pay the securities transaction tax. In paintings kind of stuff, in movable property, you don't pay securities transaction tax. So if securities transaction tax is not applicable, then whatever income you gain in the short term, it is added to your total income, right? For example, in this annual salary of 10 lakh, whatever gain you will get from the short term capital gain, it will be added to this, and you will be taxed at the given slab of income tax, whatever is your slab of income tax for the total income. So that is how we that is how the system of long term and short term capital gains tax is there in our country. Now let us discuss the income tax in a little more detail, okay, because this is something that every individual deals with, and I want to put it here for knowing more practical stuff of this. So as we have already seen that there is a kind of progressive taxation system in income tax in India. We know that as your income increases, the tax rate also increases. You may want to visit the previous video to understand what is progressive, what is proportional, what is regressive taxation, right? In progressive taxation, the tax rate goes on increasing. The tax rate goes on increasing as your income increases, right? So we have already seen that, okay, say up to 5 lakh, the income tax rate is 10%, then 5 lakh to 10 lakh, it is about 20%, then more than 10 lakh, it is about 30%, like that, right? Then there are some surcharge also after a particular amount of income. So this is a kind of progressive taxation. Now in India recently, since 2020, last 2 years, there are two tax regimes in India. One is old tax regime, one is new tax regime. The new tax regime was introduced in 2020. Now let us understand what is the difference between the two. New tax regime aims at simplifying the tax administration. What is the purpose of this new regime? It is to simplify the tax administration. See, previously there were a lot of exemptions and deductions from the taxable income. There were lot of like more than 70 exemptions and deductions were there in the Income Tax Act. What is the meaning of exemption? Exemption meaning the income which are free from tax. For example, income from agriculture, it is not taxed at all, so they are known as exemption. ऐसी कमाई जो जिसके ऊपर टैक्स नहीं लगता उसको exemption बोलते हैं. Then deductions are, these are removing certain investments and expenditures the taxpayer makes and then calculating the taxable income. For example, your gross salary for the year is 10 lakh rupees, but you have invested, say you have invested 1 lakh rupees in certain amount of shares, and if this is a allowed deduction in the Income Tax Act, then your taxable income will be 10 lakh minus 1 lakh deductions. So deduction will be, it is a kind of expenditure and investment. For expenditure meaning there is some kind of medical expenditure also involved here. For example, if you spend on some accidental medical expenditure that you make on medical and health emergencies, they are deducted. Then certain investment like investing in certain kind of shares, investing in exchange traded fund of the government, different kinds of investment. So the government allows those kind of deductions from your total income, and then after deducting you calculate the taxable income. Okay, and it is done not just for income tax but also for corporate tax also. So they are known as deductions. In the old tax regimes, there were more than 120 exemption and deduction. Okay, not 70, there were more than 120 exemption and deduction, and there was a lot of complication in the tax system. So normal people don't really understand these exemptions and deductions, and therefore the tax system was very complicated. It was very difficult to understand. What the government has done in the new tax regime, it has removed almost 70 of these exemptions and deductions. Out of 120, government has directly removed these 70 exemptions and deductions. Okay, in the new tax regime, and there is a change of number of slabs. In the previous one, there were certain slabs, like for example 0 to 5 lakh 1 tax rate, then 5 lakh to 10 lakh some tax rate, then more than 10 lakh 1 tax rate. So there were say 3 different tax rates, but now the tax rates have increased. For example, 0 to 2.5 lakh 1 tax, then 2.5 to 5 lakh, then 5 to 7.5, then 7.5 to 10, then 10 to 15. I am just giving you an example. So the slab rates are more and it is gradually increasing. So because of this, what is happening that wherever you are fitting, for example, previously if you are fitting, your income was say previously your income was 7 lakh. So previously you were fitting in the in this slab 5 to 10 lakh, right? But now you are fitting in 5 to 7.5 this slab instead of fitting into this bigger slab 5 to 10 one. So there is some benefit for the taxpayer here, but there are certain deductions and exemptions which are not allowed. Okay, now let us look at them. What are the different kinds of exemptions and deductions which were allowed in old tax regime but not allowed in the new tax regime? Which exemptions and deductions are not allowed in the new tax regime but they were allowed in the old tax regime? Let us look at that. For example, the leave travel allowance. This is the allowance that you get in order to travel somewhere. This may be an annual allowance that your company pays you or the government pays you. Then HRA, house rental allowance, right? Then there was a standard deduction of 50,000 rupees. Deductions under ATTTA, TTB on interest from saving account deposits, right? So these were the different kind of deductions that I am talking about. Then entertainment allowance, professional tax deduction for government employees, interest paid on home loans, okay, under section 24, rupees 15,000 from family pension. This was the deduction that was allowed. Tax saving investments except deduction under section 80 CCD employees contribution to NPS. So tax saving investments included different kind of investment that, for example, investing in mutual funds, shares, to the NPS. So all those have been removed except for this one investment, which is employers contribution to the national pension scheme. Okay, this is still present in the new tax regime as well. Now some exemption and deduction are retained in the new tax regime. So there are some exemptions which are present in new tax regime. For example, income from life insurance. So if you are getting some income from the life insurance, for example, you have invested in LIC and now you are getting that money back, so that income is not taxed. then agriculture income is still exempted from income tax, and leave encashment on retirement is still exempted from income tax. So these are some exemptions and deductions which are still retained in the new tax regime. Finally, let us look at what are the different tax rates for old and new tax regimes. So as I have told you, more slabs have been created in the new tax regime. You can see that up to 0 to 2.5 lakh in the old tax regime, the tax rate was nil. In the new tax regime also it is nil. Then the slab for 2.5 to 5 lakh, again the tax rate is 5% in old tax regime and 5% in new tax regime. Now here the difference starts here. Okay, so previously there was just one slab of 5 to 10 lakh where the income tax rate was 20%, okay, for 5 to 10 lakh flat. But now the government has split this slab into two. So for 5 to 7.5 lakh in the new tax regime, the rate is only 10% instead of 20%. And for 7.5 to 10, the rate is 15%. Okay, this is the new tax regime. So you can see here that previously there was a flat rate of 20%, but now it has split into two smaller slabs and the rates have also reduced. Similarly, in the previous tax regime, in the old tax regime, for 10 to 15, this was one complete slab and the rate was 30% flat if your income is between 10 and 15 lakhs. But now the government has split up this slab into two slabs. One is 10 lakh to 12.5 lakh, the new tax rate is only 20%. And for 12.5 lakh to 15 lakh, the new tax rate is 25%. So see, again, there are two slabs and the tax rate has also reduced. More than 15 lakh, then in the old tax regime also it was 30%. In the new tax regime also it is 30%. So this is how you can see that the more slabs are present in the new tax regime and the income tax rates are also lower here. But in new tax regime, you don't get a lot of exemptions and deductions, that you have to keep in mind. So you have to decide which one you want to opt for, right? Because on one hand, you are losing certain exemptions and deductions, but on the other hand, you are also paying less income tax because of the lower rates and more slabs. So you have to see in which category, in which regime, you will pay the lesser tax, and depending on that, you have to decide. Government allows you to choose whether you want to file your income tax return in old tax regime or new tax regime. As of now, it is allowed. So basically, with the new tax regime, we are moving towards a simpler tax system. We want a simpler tax system to be there. More slabs, but no need to worry about so many deductions and exemptions. We don't have to worry about deductions and exemptions. We don't have to hire so many CAs and expert professionals, because now it is very simple. Okay. But there are more slabs also, that is benefit, but at the same time you don't get exemptions and deductions. So I made this particular video and I extended this to explain to you this old and new tax regime for working professionals also, so that they understand what is the difference between the two, because most of us don't really understand it. Okay, I hope it is clear to you now. We'll discuss taxes in India in more detail in the coming videos. Thank you.